All right. Well, I am very happy to welcome Tomasz Tunguz, who is the GP of Theory Ventures, which is actually, you guys just raised your second fund. Congrats on that. It's a $250 million fund. You invest in technology companies anywhere from $1 to $25 million check sizes. I get that right?
Yes, nailed it.
All right. Perfect. I'm going to just dive right in and rather than do much more of a wind up. So thanks for being here. What did you get most wrong about crypto?
Boy, that's a good question. I thought it would be more in the US. Like 3 or 4 years ago, I thought that the regulators would be a little more lax than they were, seeing that it was such a huge opportunity for innovation and how important technology has been to the US historically. And so I was surprised by the choke point 2 and the desire to really push. I mean, I remember reading a paper 3 or 4 years ago on CBDC, central bank digital coins. And I thought for sure that by now the US would have a digital dollar, particularly because the Chinese had a digital yuan, you had the sand dollar in the Bahamas, El Salvador was buying Bitcoin. And so I think I underestimated the degree to which the regulatory regime cracked down on crypto in the US.
And I guess, presumably that had something to do with, the market turn and things like that. I guess, so presumably that means that you think the incoming administration will change things for the better in that regard.
I do. I mean, historically, look, foreign exchange, the largest financial market in the world. And very little of it happens in the US. Very, very little, because we outlawed it. And so Hong Kong and London became the centers for foreign exchange. And now, maybe it's come back to some extent, but reality is that most of the volumes are still there. And so I think there's this beautiful part of crypto and Web3 where it's a new, I don't know what you want to call it. I think it's a new asset. There are new venues for exchanging these things. There are new business models. And as a proud American, I think it's really important that we have most of that innovation here.
It's funny you mentioned that about Forex, because it's like, in some ways, the beauty of being the reserve currency of the world is that we don't have to do Forex. Everybody else does. That's their problem. We just use dollars.
Yeah, that's right. But anyway, I still think we want the venues, right? That ability to understand what's happening in these markets and to have Americans involved in those markets is critical. The way that we've
been able to...
Yeah.
Sorry, go ahead. I was just going to say, what did you get most right about crypto? I guess relative to consensus.
I invested in 2 different L1s, or one L2 called Arbitrum, and it turned out that worked really well because you have the base level of Ethereum, and it has a certain amount of processing power and speed. And I view L1s and L2s as databases. So like 3-4 years ago, it was about 1,000 times more expensive to write to a Web3 database. Today, it's about 150 times. And so I think betting on that reduction has done really well. Miston/SWE, we invested at the first round, and now I think last time I checked, it's a $43-45 million market cap. So I think we were able to position ourselves right, betting on at least that part of the infrastructure.
Yeah, you've written, I think it's really interesting, and I'll let you unpack it, that Ethereum is the greatest profitability turnaround in history.
Yeah.
What do you mean? What do you mean by that?
Okay, so in the first quarter of 2020, the numbers, I think they'll be right, but it's been a while since I wrote that post. But I think in Q1, Ethereum on a percentage basis was the most profitable publicly traded software company, right? It's publicly traded. It's not listed on the New York Stock Exchange, not listed on the NASDAQ, but anybody can go and buy ETH. And in Q1, it was burning, I think, $1.5 billion a quarter. And then within 2 quarters was producing about $250 million in free cash flow. I think those were the numbers. And so within the span yeah.
But even just pause there for a second. What does it mean? I think I get where you're going, but what does it mean that ETH is burning and generating free cash flow? Like it's not a company. It's not charging SaaS fees. What does that even mean?
Well, every time somebody uses the network, they pay a fee, right? If I want to transfer Ethereum or an NFT, some image from me to you, but about that. I could sometimes it's $25, sometimes it's $75 if you want to do it on ETH, and so you aggregate all those fees, and that's the revenue. It's basically fee revenue. Some of that goes to validators or computer people who operate computers to stamp the transaction and say this transaction is valid. And so you take the revenues minus the costs, and then you have free cash flow.
And that free cash flow accretes to whom, though?
Well, the free cash flow right now accumulates to the foundation, right? And so that it's not being distributed. It's like, Facebook produces free cash flow, and if you're a shareholder, maybe at some point in the future when they issue a dividend, you'll receive it. But right now, the corporation maintains it, and that's what's happening with a lot of these crypto companies that are producing significant income. That's the way that they finance their operations. They pay their people.
So does just like owning ETH itself, does that give you exposure to that income? Like,
it's not now. It's just the same way. I mean, okay, so the reason we hold a stock, let's say we hold Facebook, is because we believe at some point it will produce free cash flow, and then as a shareholder, I will receive a fraction of that cash flow. That typically happens when companies are growing 5 or 10%. They'll start to pay dividends. Microsoft, for example, pays dividends. Salesforce growing 9% does not. But before a company starts to grow slowly, for us, as a perspective of VC, they grow really fast. And when they grow really fast, they don't pay dividends, right? When we invest in a startup, they're not paying dividends. When Klaviyo goes public or ServiceTitan goes public, they're not paying dividends. But at some point they will. So what we do is we value the company on future dividends. And so because the company's growing 30% for the next 10 years, at some point it'll hit this revenue, and we're projecting a certain amount of free cash flow and dividends to come from that free cash flow. And so as a result, we back into a PE multiple, which is expressed as a revenue multiple today because there's no earnings. There's no free.
Sure. But I mean, like I guess, like, who is in the case of Ethereum, who is the analogy to Facebook or to Meta is who, though? Is it the protocol? Like, there's no, I mean, when you buy shares of Facebook, you're buying, a legal share of ownership of the company that generates those earnings. And at some point, you trust that management is going to want to reward shareholders or be forced to in some ways. But like, who is the company? In other words, okay, so maybe it makes sense to invest in companies that are doing work on the Ethereum chain, but like, what does that mean for Ethereum itself? Like, if I hold, I don't know, $100,000 worth of ETH, what is that? Who's going to at some point decide to dividend out money?
Well, the community, right? You can, like, a shareholder will vote. Right? If you hold shares of Berkshire Hathaway stock, you can go to the annual meeting, and then there are resolutions and people vote. The same mechanism works for Ethereum. There are EIP resolutions. And so they can decide to change the protocol in one particular way or another particular way. And one of those changes might be excess profits are now dividended out at a 10% rate of overall free cash flow. Just the same way that a Tesla shareholder might vote on Elon's compensation.
Right. Are you surprised then that that Bitcoin and ETH have decoupled a little bit?
No, they're different. They're really different. ETH is like AWS. It's a big cloud, and so that's what it's a big cloud. And Bitcoin is I think, like a digital gold. It's a store of value. You're talking about. I mean, there are rumors that the U.S. federal government they have I think 22 billion last time I looked last night of Bitcoin on the balance sheet, primarily through criminal seizure. And there's a resolution to authorize the government to buy another 22 billion. So they would have 40, and they would put that on the balance sheet and hold it in the treasury the way that I think we have like 884 metric tons of gold. And so it's just another asset that we have. So I couldn't imagine the U.S. government, or any government for that matter, buying a strategic reserve of ETH, because it's ETH is buying compute and Bitcoin is more like a commodity. It's like gold or pork bellies.
So it sounds like I guess it would be fair to say that you're much more interested in ETH than you are Bitcoin.
I mean, as an institutional investor, we're much more interested on the databases, the core infrastructure, stable coins, movement of money, payroll, those kinds of things.
Yeah. Does it bother you at all that, like, that SBF is a huge villain, but almost everybody was made whole after crypto prices recovered, and Anthropic was a great investment and all of that?
I think, I don't know a lot of the details of the case. There was still some money movement that shouldn't have happened across Alameda and FTX,
Sure.
to my knowledge. And so, and then but there's also an argument to be made that FTX would not have been insolvent had the government not intervened in the way that it did in the signature bank. So, look, I think progress is a ragged edge, and it's never clean. So there will be casualties or injuries along the way, and unfortunately, I mean, he was one of them. But I'm really glad that all the stakeholders within FT, I mean, it turned out roses for everybody. People didn't have
Yeah.
access to their capital for 3 or 4 years, but it wasn't a Madoff story where shareholders were recuperating dimes on the dollar.
Yeah. Yeah. No, I mean, I mean, it is a surprisingly good ending for who, for a guy that was a major villain for a period, at least. So the people seem to have forgotten about it. I'm gonna shift gears quickly. So you've heard of AI, I assume. Uh, um, what's interesting in AI, and more specifically, I guess, how do you think that your perspective differs from, like, I guess, the conventional wisdom at this point?
Yeah, I mean, I think, okay, so one thing is Google has come out of nowhere in this ecosystem. And I was chatting about it in our family this morning, which is like a year ago. I think the consensus on the street was that Google was really far behind, would have a very hard time catching up. And then I was looking at some statistics, technology called Open Router that tracks how much developer traffic is going to which different kinds of machine learning models. And Google's at 50% share. And the performance. So that's one. The second thing that's really surprising in this ecosystem is the power of the open source models. You can download a Llama model. I was running one this weekend, which is just as powerful as GPT-4, and I'm running it on my computer. It doesn't run nearly as fast, but it's free, and I can do whatever I like with it. And so I think the fact that Google has really surged the power of the open source models. And then the third is a lot of the narrative within the ecosystem has been trumpeting the largest models. There's this race to make the models bigger and bigger. It started with like an 8 billion parameter model, then 70 billion parameter, then we got to like 150, and then the Llama 3.3 is 405. But the performance of the mid-sized models, say 20 to 70 billion parameters, are just as good as some of the state-of-the-art massive models. And many enterprises are trying to push to smaller models because there's a 100x or 500x difference in inference costs for those smaller models with a very small trade for overall accuracy. So I think, that's the exciting part about AI. We had this narrative, I think maybe a quarter ago, where people were talking about how progress had really stalled. I would argue that in the last 2 weeks, particularly with like the video models, or I don't know if you've played around with the AI Studio where you can show Google's AI what's on your computer screen and just talk to it as if it were a really sophisticated human. I think it's starting to become real in a very tangible way. And I can't remember the last time I was so excited about a technology. I mean, I was in the car with our kids, and it's like the car is driving itself and we are talking to Gemini Live about whatever they want to hear. I mean, never would I have imagined.
And that's so much better than I remember, what was it, OK Google, or that was their prompt, and the Alexa,
Hey Siri and all that stuff. Yeah, it's completely different.
No, I see that. Going back to the open source bit for a second, and as well as, like, whether or not models continue to improve at the same rate and pace, like, isn't it kind of crazy that these are, I guess, multi-billion-dollar models, and you have this huge divergence where some people are giving it away for free, and some people presumably are going to try to monetize access to that model directly. I mean, how is that going to? Are there two winners that are going to emerge? I mean, or does somebody get burned, or like, how is that going to play out?
It is awesome. It's capital markets working at its best, right? I think there will be many winners in the AI space. There'll be segmentation. So certain customers will really want whatever closed source models that they can tune with particular vendors because of the attributes. I mean, Claude for us, Claude is really good at manipulating text. If you have a blog post or a newsletter that you want to edit, or a YouTube transcript from a podcast that you'd like to summarize, Claude is the best And it may be nuanced. It might be hard to tell in quantitative evals, but that's the one that I'll go to each time. Whereas if I'm looking to understand a market, Gemini, particularly with the deep research or the new model Flash to Flash, exceptional at it. There's nothing even close. Coding, I think OpenAI and Claude are basically on par. So we're starting to figure out, I think at least, and I remember this in the search engine days, you had Metacrawler and Ask Jeeves and Alta Vista and all these different search engines that no longer exist. And Metacrawler was the best. I liked it because it scanned lots and lots of websites and it was really good at doing that. Whereas there were other ones who I've forgotten now, but that were really good at stocks, for example, or whatever it was. So I think you'll start to see the segmentation, and it'll probably be by use case. So the really big, heavy models that are super expensive, they're great at answering any arbitrary question. Right? It's like Google search. You have no idea as a product manager on Google search, what is the next user going to ask? The universe is infinite. And so you probably want a really big model to handle that universe. Whereas if you're building a system that reads W-2s for tax optimization, you don't need a really big model. You need a really small one that's focused on that task. And so there'll be the segmentation.
But it's funny that you mentioned like you bring up Ask Jeeves and the other but they're gone, right? The end of that story is they disappeared.
They did, but they created a lot of value, right? A bunch of them were acquired and integrated and folded. And so,
Fair.
Yeah.
So, okay. So, I guess but can you think of any other asset? I don't know if it's even fair to call it asset that is quite this expensive where your comparative advantage gets traded away quite so quickly. Like in other words, if it costs $5 billion, let's just say, to train a new model, and then within a few months you have other models that have caught up to you, and they're essentially or either giving them away for free or just undercutting on pricing. Like I can't think of anything else that's worked quite like that, or how that could continue to work that way.
Yeah, the capital intensity. Well, I think
what's the capital intensity and then the speed of amortization, really, right? The useful life of these models just hasn't been long.
No, I think that's true. Yeah, you look at the open source models catching up to 3.5, open source models catching up to GPT-4. I don't think you've had a window as a vendor to tout a new model's advances for maybe longer than a quarter, maybe 2 at the upper end. And so you have this rapid period of commoditization. I don't know. I was thinking like telecoms, like 4G versus 5G, rapid commoditization because the standard is developed and then everybody rolls out. And so there's not a lot of share shift. Whatever, Verizon gets 5G ultra wideband faster than AT&T. No one is, maybe a few people, but effectively no one is migrating their loyalty to a carrier. I've been wondering around and I don't know enough about steel production, but the mini mills of the 1900s that people actually change buyers as the mini mills rapidly commoditize the production of steel. I don't know. I don't have a good answer for you, but I agree. I think and there's that dynamic that's really important. And then the other dynamic is that the cost pressures catalyzed by the rate hikes in 22 are still very much in play. AI, in terms of enterprise adoption, faces significant cost pressures, which are unlike the previous decade. You had Snowflake and Databricks. The office of the CFO didn't impose that much scrutiny on the account size growing 170, 180% per year. But here within the world of AI, less than 2 years after the launch of 3.5, people are starting to pay attention to what is the margin structure? How much are we paying? How do we reduce the overall cost?
So where is that spend going to come from? Is it going to come from service or a payroll or headcount rather, or is it going to come from other software?
Yeah, I think it was Bank of America or Morgan Stanley put out a survey 3 months ago or so that showed that about half of it is coming from existing software spend. So it's software budget being repurposed, and then about 30 to 40% of it is net new, which narrative violation to what I just said. I think overall the narrative within Silicon Valley is that ultimately it should capture labor spend, but I don't think you'll see it as a discontinuity. We're talking to our portfolio companies. They're not hiring as many people as they once were. So the head, and so that's the way that
I mean,
I
we
think.
see that everywhere. I mean, it's just like, it's just not. Yeah. So do you like, I don't know if you're, like, do you see that the sort of continued earnings growth without headcount growth, is that AI already, or is that just financial engineering, or is that just doing more with less, or like even at public co level?
Yeah, I mean, I think you're going to start to see massive earnings increases in a bunch of these companies. Um, I just like, and it's probably a one-time boost, and then ultimately sustained. Klarna is very famous for pronouncing. I think this week they cut 25% of headcount, same productivity, and so you'll see some pretty. And then the revenue per employee benchmarks are no longer relevant. The R&D, the sales and marketing benchmarks are no longer relevant. So I think I was chatting with a friend yesterday. The overall sizes of startups, I think, will be significantly smaller because
But
we'll
but
just
but
expect
Elon
that
did the
to.
same thing with Twitter, and that had nothing to do with AI, right? He just trimmed the fat, or a good chunk of it. Maybe he over trimmed or something, but
Yeah, that was a remarkable story. I think that's a little bit of a different animal. I think the ZIRP era created the very, very low cost of capital, and so you had very forgiving capital markets. And Elon's purchase, all of a sudden, the cost of capital was significantly greater because it was ultimately his capital, and so he said, "This stuff, I'm not going to pay for it." Um, and I think, like, in this era, I mean, one of our founders made this analogy with like farms, right? Like 100 years ago, how many people did you have working on a farm? And today you have somebody managing 20 GPS controlled combine harvesters, and the productivity is that much better. I think in a
yeah.
lot of the rote work, you'll see very similar dynamics.
But it's also like an interesting analogy when it comes to farms, because like farms are heavily subsidized, partly because like it's almost a commodity at this, it's almost a utility at this point, like large scale, industrial farming, which is, like the utilities that are generating energy. I mean, I don't know, I see that as a potential path for some of these foundation models. Do they become something like a utility? I mean, and so like, even just to extend the thought further, my most like I'm not generally terribly favorable towards regulation, and I think some of the AI safetyism stuff is overwrought. But I guess like to me, the sort of backdoor, most charitable version of some of that, some of those regulatory efforts was, okay, we need some kind of cartel, that can exist, so that they can, capture some of the benefits of all that upfront R&D. You know what I mean? Like if it gets competed away quite so quickly, then nobody can justify the upfront investment, if that makes sense.
Yeah, I mean, I understand the argument academically. I think the reality, I mean, Google, Microsoft, and Amazon are spending $100 billion a year on capex, and the
Yeah.
U.S. has like, I think, 1,200 data centers, and the next biggest country might have 100. So it's true. I think
But Microsoft only has 100 billion in earnings every year, so it can't, right? Presumably, it can't get bigger than that, I would think.
yeah, or they can raise debt, right? But anyway, so
Mhm.
they can finance and they could ask a real estate company to develop, like an Equinix to develop. Anyway, so I think there's ways, but if you read the earnings transcripts of like Google and Microsoft and the others, the the investment banking community presses them on capex, and it was huge sums. They believe
Yeah, no,
ultimately
they
that
are.
the ability to commercialize these models would be enormous. And I agree. I think the impact to GDP of AI over 15 to 20 years will be gargantuan. Um, and so, I, I think it's there. I do wonder, like, at some point, some of these training runs are so expensive. Does the government, just the way that they did with solar panels, start to lend significant amounts of money because it's
Yeah,
a national security issue, and it's a training run of $10 billion or a training run of $20 billion is hard to justify commercially without a significant
yeah.
government contract. So maybe that happens.
Yeah, no, I mean that's sort of the flip side, I think, of the argument is just that, when the government tends to lend and get involved, they tend to put strings, as that should be their prerogative. They tend to put strings attached. What do you think enough? Like, what do you think some of the second order effects of all of this capex is? Like, in other words, we're putting huge amounts. It's the grid is an obvious example, right? I think is like, are we going to look at hydrocarbons the same way that we look at whale blubber? Like, is it going to be, what else might you do with all this new compute or liquid cooling or all the different sort of ancillary technologies that are being invested in, as that are that are downstream of AI right now?
Yeah, I mean, I think the first is you have an opportunity to modernize an aging and a creaky U.S. electrical grid, very likely with modular nuclear power. I think that's maybe coupled with renewables. And so maybe hydrocarbons go down. U.S. becomes a bigger and bigger net exporter of hydrocarbons to other economies as it has over the last couple of years, and that has broader ramifications for geopolitics. But I think like that's like the most tangible one. I mean, I think I don't think it's crazy if like you're relative like a medium or a small town in America, you have a data center and a modular nuclear plant. And that modular nuclear plant charges cars, and there's a solar panel field, and the grid is decentralized to a much larger extent, which is important for national security because right now the US grid is basically, I mean, do you remember when New York, when there was that massive power outage, I think in 2002, I was
Yeah,
I was on the phone with my sister.
it's the day of my sister's wedding.
Oh, really?
And married.
Oh,
She got
tell that
married in a
story.
blackout. Yeah.
Yeah.
No, I mean, that's just what it is. We were all getting ready for pictures in Greenwich, Connecticut, and the lights went out in the hotel, and it was just like, and then news started to filter out. I mean, the end of the story is that it was the middle of August, and we had to choose between amplified music and air conditioning, and we chose amplified music. So it was fun. It was just a very sweaty wedding. That's my abiding memory of it. Sorry, go ahead.
No, that's awesome. I mean, I was working in the MetLife building, which was right above Grand Central Station on the 37th floor. And I remember walking down and seeing civilians guiding traffic and no electricity anywhere. And then starting to learn a bit more about it and how it was a series of cascading faults from New York to Ohio and then all the way up the Eastern Seaboard. Well, it turns out if one system, someplace, the part of the electrical grid becomes out of phase with the rest, you have these catastrophic failures, and it's because it's this big, complex, monolithic system. Anyway, so long-winded way of saying I think there's a real opportunity to leverage a lot of this investment in data centers to modernize the grid.
Yeah. So how are you underwriting? Like you've made the argument in the past, I think, if I understood it correctly, that the AI valuations, even at the early stages, are not. It's not frothy. It's not over. There's not. You don't think there's too much hype there. So that's part one. And I guess the sort of inverse of it is how do you underwrite these AI companies right now? And is it different than you've underwritten things in the past? Or
it's very different. I mean, 10 or 15 years ago, a company growing from 1 to 3 million in revenue per year was probably top quartile in software. And then 5 years ago, we started to see companies are growing 1 to 5, 1 to 6. And then at the peak of Zero, maybe 1 to 7. Now we're starting to see companies are growing like 1 to 10, 1 to 20, 1 to 30, 1 to 40, 1 to 90 in a year. And so the growth rates here are exceptional and unprecedented in my investment, admittedly very short investment career on a global scale. And so the underwriting becomes very, very different because it's all about understanding what's the durability of the revenue. If I'm looking at a company that's growing from 1 to 20, and let's say I apply 30 to a 50 times forward revenue ARR multiple on it, so it's growing 1 to 20, maybe it's 100 next year. Probably I'm paying 2 to 3 billion for that company that's about 12 to 18 months old. And if the revenue growth slows pretty meaningfully, then all of a sudden the value of that stock also. And so it's very, very difficult. Yeah. It's very difficult to price companies. And the earlier you can be, as always, the better, because the risk reward there, I think, is a bit more attractive. It requires a lot more work. Or you build a broad index, which is another viable strategy that's happening in venture capital, where people just say, I'll raise a big fund and I'll invest a little bit in all of these different categories, and a handful of them, the asymmetric returns will generate enough to offset any potential losses or reductions in values resulting in decreasing growth rates.
Our question: if you're generating 90 million in revenue within a fairly short period of time, why are you raising venture capital at all?
Well, because the burn is so high, right? Like,
yeah. And what's the burn attributable to? Is it just compute or something else? It's not head count, right? It's not ads.
Well, it's all of those things. It's office space. It's definitely people. I mean, humans will sell software for the foreseeable future. Inference costs and training costs are really significant, and so it's not it's possible to see a company generating a lot of cash really early, but for many of these businesses, they're not anywhere close to profitable. They're also, most of them, or many of them, are operating at margin structures much lower than classic software companies, or publicly traded around 71, 72.
Interesting. And could they improve their margin like profile if they wanted to, or is it just the nature of, they couldn't, they just need a degree of scale that will, that eventually that'll turn positive.
I think the fixed costs are higher. In other words, like the startup cost, but at scale, I don't know if they'll get to 70. I mean, it's kind of a case by case. But I think you'll start to see software margins emerge in 5 or 6 years again after these companies reach a certain level of scale.
So I guess what keeps you up at night about the AI ecosystem or some of the AI investments, and like, what do you worry about? What's a red flag that you kind of keep track of or anything like that?
Yeah, I think, I think one of the hard parts, it reminds me a little of crypto in like 2020, 2021. You'd go to sleep and then all your information would be outdated because somebody has released a new architecture or some new prompt engineering technique. And so the implication for our portfolio companies is we want to make sure that our companies benefit from improvements in models and don't suffer from improvements in models. That's a really big thing. I think the other thing is the pace of innovation is so fast that maybe some techniques or some approaches are just outmoded. We were looking at a sector that was really hot. I don't want to name it, but we were looking at a sector that was really hot in 2020 and 2021. And we're just kind of going through the companies earlier this morning from that era. And today, most of the founders have either sold or left those businesses. And so it just doesn't exist as a market, as an attractive market anymore. So could you see whole segments of software no longer being relevant because people are selling outcomes instead of software?
Yeah. I think it's also kind of striking because VC is, such a long hold period, and so you're investing over 7, 10, 12-year time horizons, but the technology is changing so quickly. It's a hard problem to solve.
Yeah, it's a lot like crypto. It's a lot like crypto in 2020 and 2021, where just you had new techniques and new algorithms. A lot of the research is in academic papers, which for the first 10 years of my venture, I mean, I'd never looked at an academic. I Google it, sure, but after that, we were not going deep into the internals of distributed systems or databases or information retrieval architectures. But now we are.
I was gonna ask about that, but I'll step away. Do you think LLMs are gonna put well-known like publicly traded SaaS Cos out of business?
Yes, I think for the first time in 20 years, all of the major software companies are vulnerable. And that's because all of them are vulnerable. Why? Well, so business software is workflow software. And as companies become bigger and older, they calcify around those workflows. They expect people to operate in the sales function. Here's a sales development rep who certain ratio with an account executive, and here's a customer success manager, and here's how the way we sell, and we write books about it, and people are educated on it, and then organizations thrive using that model. And all of a sudden the workflow changes. AI completely changes how an SDR, sales development rep, generates pipeline. And instead of managing one inbox, maybe they're managing 25 or they're managing 50. Or an account executive now is handling twice the number of accounts, or a marketer is producing 50 times as many blog posts or social media posts as they once were. So then the assumptions, the assumptions that were then baked into the underlying workflow that have been calcified over 20 years, it doesn't work anymore. And so if you're an incumbent, well, okay, time to re-architect. That'll take a while, both because at a large level of scale, you're primarily going after bigger and bigger companies who tend to be the slowest adopters of these technology, but also because you promise a certain number to the street. So it's really difficult to burn the boats and go after a completely new workflow, potentially cannibalize some segment of your business.
It's interesting, but isn't like the counter argument that as you pointed out, also the barriers to entry for bringing AI products to market are relatively low and lean. And if distribution is a huge edge, and like in partly what these companies are doing is like tinkering at the feature layer, like here's the thing that you already do, but we're going to make it better with AI. I mean, isn't that you don't see that as an incumbent advantage?
I do, but I think it's short-lived. And short-lived meaning an order of a few years, because
So somebody's going to crush ServiceNow eventually.
I think so, and Salesforce, and anyway, you can let's make this argument with your phone. So I don't know if you played with Apple Intelligence. I've seen it. I have an Android device, but it's been described to me as a feature on top of an operating system. It feels that way. It's disconnected. It's not fully integrated. And I think in the future, I mean, we're at the level of her, right? If you watch these demos from Google and OpenAI about being able to engage with the computer sees what you see, hears what you see, you can have a conversation about it. There are all kinds of implications of that. Privacy is really important. Latency is really important. But you probably want a system, underlying infrastructure and a system that was designed to handle those kinds of interactions on an ongoing basis, rather than what was Steve Jobs' famous line, a combination of like a browsing device, a phone, and I can't remember what the third one was. But the iPhone and most modern phone architectures are designed to do totally different things. And it's the same for computers, and it's the same for workflow software.
It's interesting. So it's just like it's not quite the innovator's dilemma, but it's just like there's a kind of paradigmatic shift in terms of where most of the value is going to be unlocked, and it's almost like it's almost like an API thing. It's just like or making it AI native rather than try to build features on top.
Yeah, I mean, I don't remember we had our iPhones, and our iPhones could tell us the location, and then there was the App Store, and the App Store was all these websites and encased in what we called apps. And then Uber came out. You're like, whoa, that is a native app, right? It knows my location. Now all of a sudden there's this huge new opportunity, and no one can compete with that. And so going to your point about like the nativeness of it, I think that's what we'll see.
So shifting it for a second on just like venture more broadly, you again have written like a through line of my work has been in identifying technological discontinuities that enable go-to-market advantages. What do you mean by that?
Yeah, I know it's a lot of words. Gartner ran a study, and over 5 years, they saw that the cost to acquire a customer for software companies increased about 60%, monotonically increasing. So what does that mean? Well, whoever's the biggest balance sheet wins, because if I can play the big chip stack in poker and just increase the cost of customer acquisition, and I'll win. And there's a great Harvard Business Review case on like American Airlines predatory pricing. The company just keeps raising the prices, the small guys disappear. And so for a startup to succeed, they need a way of acquiring customers that's less expensive than American Airlines. Right? So how do you do that? Well, you come up with some awesome technology. And people say they read about it, or they try it in open source, or there's an existing company who really wants to partner because your incentives are aligned and competing with an incumbent. And so that's the whole idea, is developing a new technology where all of a sudden you have a cost of customer acquisition advantage. And if you have that cost of customer acquisition advantage, then your smaller balance sheet doesn't matter. It's not a weakness anymore.
Yep. So, and that can manifest in any number of ways, just by being that much better, or being, I guess, in community advantages too, I suppose. Like, did you ever get interested in like the creator economy, like people who are using their own little sub audiences as distribution or anything like that?
Yeah, so we've researched the influencer. I mean, that's fast. One of the fastest growing parts of the advertising market is the influencer ecosystem. Open source for the last, say, 12 years is a marketing channel where the cost of customer acquisition approaches zero. People try out the software themselves, they become buyers, they raise their hands, and they're ready to go. And so there were lots of companies that we've worked with in the past that build those kinds of open sources. So there are constantly new waves, and it's important to understand how that works. If there's the mobile app store was a novel one where distribution suddenly changed. Social media was another one. AI, I think, will be another.
Is what is the VC value add? Isn't like your money just fungible? I mean, why? What value are you adding?
Yeah, I mean, I think the money itself is fungible. You can use it to pay anybody or do whatever you want. I think the first is having a level of expertise and depth, and that's what we try to do. We have a research team called the intelligence team and we spend a lot of time as a firm going deep. And understanding a space and having those nuances means the board is just that much better in helping a company, rather than constantly requesting the team to explain what it is they're doing and then remapping it to the mental model of the world. I think the second thing is networks, right? Being able to introduce founders to the right buyers, understand the different nuances between the market segments. We invest a lot in accelerating the sales team development for our companies so we can save them 2 quarters of learning on sales, and compounding happens at a higher rate, produces a lot more enterprise value. And then the third, I think you really want to be a counterweight. So if the company is doing really well, it's time to be critical. And if the company is going through a hard time, most important thing you can do is encourage the people, the founders who you backed, to keep going.
But isn't that, I mean, if it's, I mean, aren't those huge advantages for like the mega funds, right? In other words, if you're saying, they can hire bigger research teams, they have bigger networks, doesn't that in favor of signing up with one of the, like, one of the multi-strats, so to speak?
Yeah, I mean, they do. They definitely have more resources, bigger teams, but I think, I think the specialization is the advantage of much smaller firms. Whereas the bigger you become, the harder it is to specialize. Not to say that there isn't certain levels of specialization, but we don't need to invest in that many companies to produce a really great fund. Where if you're a very, very large firm, your share of great businesses that you need to invest in is much higher to produce a high multiple. And so that drives different organizational structure, and there are trade-offs to both.
How do you decide who to meet with? Like, do you ever take cold outreach? Do you think there's like an error rate on that? I mean, like, how many quality meetings do you think you're missing because of whatever filter you use?
I think we do a lot of work, and we use machine learning to actually help us understand companies before we meet them. I think that will become standard in venture over time. But I don't think our error rate on inbound is that high. The thing that's hard to gauge from just an email is the strength of the team or the unique insight of a team, and that's what I worry about. It's like somebody who maybe doesn't have an obvious pedigree, but has a deep insight into a market or a space that's not obvious from the email, from the website, from the LinkedIn, the Twitter, social media, etc., or anything that they put on, where they understand what Peter Thiel would call a secret about the market, and we miss it because we didn't take the meeting.
Can you think of examples where that's happened?
Gosh, that's a good question. Not off the top of my head, but I'm sure there are many.
Yeah, no. I mean, partly the background is like in my experience, and I'm sure it's sort of what you're like. My sense is venture, they pattern match within a fairly narrow box, and they do it pretty aggressively. They look at logo, X years at Stripe or whatever it might be, and then they kind of form a fairly high conviction initial view, and then they kind of validate it after the fact. I don't know, that's been what I've seen, at least. It seems how a lot of them behave. Like, I don't know. Like, to me, it's all maybe it's the right approach. It just does seem awfully, for an industry that presumably prides itself in being unconventional or thinking differently. It seems like very conventional in its approach, but maybe there's something to it.
Yeah, I mean, I think there are lots of different styles of investing, and it's true in venture as across every asset class. And so, we're hopeful that the deep research that we do and the expert network that the community that we built around the firm help us find the ones that the companies that maybe just not that obvious or a little bit before.
Are there other asset classes that you tend to focus on or follow closely, like real estate, private credit, private equity, public markets, whatever it might be? Like, are there other, or do you stay close to venture and the venture ecosystem for the most part?
I try to understand as many asset classes as possible, because venture capital is just one part of this broader financial ecosystem. Like, I've studied the history of private equity funds from the creation of KKR through the Milliken debt craze, and then their expansion from leveraged buyouts into multi-asset, multi-strategy asset managers. And I think you're seeing that happen in venture 50 years later. Maybe Zip was the equivalent market expanding force to the junk bond era. Hedge funds, I think it's a little bit different there. But what we're trying to do is we're trying to understand the best practices of each. And we do pay a little bit of attention. One of my colleagues just posted about the bond market and the difference between what the Fed is doing versus what the bond market is pricing into long-term rates. There's nothing like immediately, we don't change our investment strategy as a result of what's happening in the 10-year. But it is important I think it's important for us to understand the ecosystem within which we're investing.
Yeah, I mean, I'm talking my own book, but I think that I think the capital markets are much more connected than people like to think, and a lot of people were caught,
Well, SVB 2022. I mean, I'm a 2016, 60% crash in software on a single day. So like, I totally agree.
Well, and that even like now, like people talk about like public markets being closed, and then it's like no, public markets aren't closed. Like they just put a premium on certain things that are slightly different than they did before. It just there's and again, I think it's probably a bit of a ZERP thing. It's just you didn't have to be terribly sophisticated about capital markets when money was plentiful. That's a shift. I want to come back to that in a second, but I guess just to come back to a question on like, I suppose you don't invest in public markets, but do you think you could, like, or venture could? I mean, something like a Co2 or like, why not? Like, why not have that strategy also, right?
Yeah, I think there are people who do it really well. I don't have that much experience in public markets. I think the dynamics within the public markets are significantly different, right? So something like 50 to 60% of all purchases are programmatic or index based, and the valuations of companies, I was talking to a friend over the weekend, only 15% of the valuation of a company can be explained by fundamentals. So this is not
over what time horizon though.
That's a good question. I didn't ask that question, but and so like you have this seminal book, Benjamin Graham, Fundamental Analysis, which was Warren Buffett, and ultimately he iterated on that model. But like, I think this idea of value investing has had a really hard time for a long time, because many of the short-term market movements are driven more by programmatic fund flows, who has computer trading algorithms, and who's buying the retail streams of that. I forget the name of it. It's basically when you ask the retail brokerages to sell you the information on which retail investors are buying which stocks.
It's like Citadel for Robinhood.
Yeah, exactly. And so that's where the alpha exists, is who's moving money. It's not Google is announcing this quantum chip, and as a result, 2 years from now, the forward free cash flows will look like this. And so I
think Google did just pop like 10% on the quantum chip thing over 3 days, but
yeah, they did. And so I think it's less about understanding the bigger architectural changes and the software than it is about understanding how the markets work.
Yeah, I still feel like if you're not trading quarters, if you are trying to think through fundamental tailwinds and structural factors and operating teams over a long enough time horizon, I'm sort of surprised. I think that more venture don't do some public markets, or maybe they'll start doing it more. On like, again, the sort of shifting but related, so like dislocation in private capital and venture specifically now, do you think that venture needs to change, or is it just a return to the status quo ante? Do you think it's fair to make some sweeping proclamations like venture's fundamentally different now, or ought to be different? Or is that just a little overwrought?
Yeah, so I think the venture capital ecosystem has changed enormously in 15 years.
Okay.
Yeah, so I think the scale of the asset class, I mean, from when I joined to the peak was 8 billion to 300 billion. I think we're roughly 175 billion now. So the asset class grown 20 to 25x. I think the kinds of financial products that venture firms offer to founders is markedly different than it was, I think, 15 or 20 years ago. Is mostly capital. And today, the level of sophistication, the breadth of different service offerings is much broader. I think the technical sophistication of most venture capitalists is bigger. And so I think, and then the use of technology within the firms themselves, the restructure. Many of these firms are now corporate, organized as corporations rather than partnerships. So there's been legal and structural changes to the way that we raise capital, the kinds of LPs that we raise from, the scale of the fund. So I think there's been an awful lot of change. I mean, the creation of like crypto funds that have both public and private books, to your point, where they're staking and hedging and building markets. That's pretty new. So I'm proud of the industry. I'm proud to be a very, very small part of it throughout that change. And I'm sure there's a lot that we can improve on, and we have seen a lot of progress.
Do you think that there's like an opportunity for, I don't know, either let's call it, one check, like one round venture or $100 million outcomes or more normally distributed portfolios? Like, is there any room for that? Or is venture still very much going to be power law, in power law outcomes for the most part, and every company you invest in ought to be, potentially a $5 billion company or something like that?
Yeah, I think there's this dynamic now within the world of classic software that's called growth buyouts, GBOs, where you have
Yep.
software companies aren't growing as fast as maybe they once were, and so venture firms and private equity firms are rolling up different kinds of software companies. This brilliant business called Constellation Software is worth like 75 billion, doing this model for the last like 30 or 40 years. So I think. I think you'll see lots. I'm hopeful you'll see many more different kinds of strategies. Secondaries would be another one. Secondaries historically have not been very important in venture capital. I think in 21 or 22 is like $3 to $5 billion raised for LP and GP led secondaries. So, yeah.
Yeah, I mean that's a sort of pass the baton exercise, but like LPs are very focused on liquidity now. Obviously, they haven't seen a lot. But like as a structural change, is it just short termism, or like should VC as an asset class think of new ways to return, new and different ways to return money to investors, dividends, I don't know, like buybacks, evergreen vehicles, something where they're just more cognizant? Or is it just, no, EDC this is a 10-year hold period. This is what we do. You gotta be patient.
Yeah, I think, because in classic software, we hold companies for 8 years from inception to M&A on average and 12 years to IPO. So it is a bit of a long dated asset class. Unlike private equity, where the positions roll every 3 to 4 years, GP and LP led secondaries drive a lot more DPI. And so there, the return of capital is more important. But, if you think about, we were just kind of talking about like the continuum of equity dollars, venture capital is really small. Then you have like growth equity, and then you have private equity, and then public equity. And the product that we sell as venture capitalists is a lot of risk, a lot of illiquidity for ideally much higher returns relative to the S&P. And as long as we can continue to provide that as an industry, I think there's a place for that kind of product in most institutional investors' portfolios.
No, that I agree with, I guess. But is there some room for some hybrid PEVs, some other kind of product that says, actually, we're not going to have this extremely high variance, or, I don't know, sort of thinking through what that might be, whether it's, we're going to have a book of $100 million companies that are less likely to go to zero, but also, less likely to go to the moon. Or is that just not possible? It's just like that first check risk is just so high that if you were trying to underwrite for a more normally distributed set of outcomes, you'd probably just lose.
Yeah, no, I think that's right. And I think that has started to happen, right? You have what's called venture growth, where it's a venture capital firm sort of investing in higher risk. And then you have like growth equity. And so there's been this bifurcation. And you do see some of these funds in venture growth who might have 10 positions within a fund. The total loss risk is significantly minimized. And
right, but those are later stage, right? Those companies have already turned over the cards. They have a business. It's a question of how big it gets. I'm talking about,
at the early stage.
Yeah,
I think that's hard because the failure rates are high, and so to be able to underwrite, say like a 10% failure rate or a 5%, on average, roughly 50% of early stage venture backed companies fail return 1x or more. So you would need some recipe to do that. Maybe it's incubation, for example. You roll the companies into other companies as a way of minimizing total loss. But I think that'd be difficult.
Right, that takes a lot of scale. Do you where do you think venture So I mean, one of the, I guess, popular strategies in venture now is much more capital intensive, whether it's, the hardware related stuff or industrial, or is that a good fit for venture dollars? Like, how do you think that's going to play out?
I think, I mean, there are periods where we go through lots of capital intensity as an industry. Networking, telecom, the internet was one, where return on equity maybe was like 3x uh, or less. And so that happens. So there's this awesome, I mean, Carlota Perez, she kind of talks about these big technological waves. She's a professor at Stanford, and there's an installation phase, like the deployment of the railroads, the deployment of fiber lines and copper to the homes, where capital intensity is really high and return on equity is not that great. And then all of a sudden there's this commercialization phase where now that stuff's in the ground, well, you can run a railroad monopoly or you can build a massive e-commerce giant, and the return on equity looks spectacular because all that stuff is already there. So I think the great part about this part of this evolution within AI is we have lots of really big incumbents who are maybe they'll plow, I don't know, $500 billion over the course of the next 5 or 10 years into next generation data infrastructure. On top of that substrate, startups will produce huge amounts of market cap.
Yeah, I just mean, like, as in, robotics grows or whatever it might be. Like, those are traditional. Like, part of why VC loves software companies is because it's not nearly as capex intensive. Like, there's that initial build out, and then, but it's just not true for hardware, right? That's why they've traditionally hated hardware because so many things can go wrong and it's so expensive. Yeah, and I think there was an interesting point. I think that the Andreessen and Horowitz made on their little conversation that where they see doing hardware as possible from their perspective because they are a multi-stage firm, so they know that they can do a kind of handoff, from their seed investment to their A to their B, and they can grow alongside it. But if you're anybody but them, how do you? I don't know. It just seems like it's hard to invest in companies that almost by nature are going to be capital consumptive for a while. Yeah. Do you what about debt, like in private credit and those kinds of things? Do you see, I mean, putting aside like venture debt, which is sort of its own thing, like, do you think that there are more opportunities for debt? I mean, certainly later stage, fine, if you're going to do some asset intensive approach, but what about in early stage companies?
It used to be very normal to raise a venture debt round alongside of a Series A. I think as the cost of equity fell, the relative appeal of venture debt decreased. If rates were to suddenly increase, for example, and the capital intensity of these businesses continues to be high, then I think venture debt, again, looks pretty attractive. Right now, most venture debt, and I haven't looked at it in a year, but it's predominantly used for M&A financing for later stage companies.
Yeah. So you're not too excited about, I guess, debt sort of entering the ecosystem earlier.
Not until rates fall.
Yeah. Are you persuaded by like Apollo and KKR, like they're building out private trading desks where they, so anticipate some future where, where privately held assets are traded almost like public ones? Do you think that's possible?
I think that will happen. I think it's just a question of time scale.
So, I mean, doesn't it require some kind of, financial reporting? Something? I mean,
yeah, it's that's exactly what had to happen to these private equity companies when they went public. They needed to figure out a way of marking their assets to market in a way that they could report to the street and people would understand. But I mean, look at there's a great book on the history of Blackstone and how Schwartzman did this. The name escapes me now, but they were ultimately able to do this. And some companies have been able to, some investment firms have been able to raise funds through the public markets. I think that's very valuable. You look at the partnership between Vanguard and HarborVest as a way of providing people with 401ks exposure to private equity, and I think ultimately venture capital. That'll be a big driver as well.
Sure, but I mean, I guess like if you're trading privately held securities, right? Like, you need to be able to look at earnings or something like that. I mean, do you see any universe where there's some kind of uniform reporting cadence among startup, whether they're reporting financials quarterly or biannually or something like that? Do you think that would be good, or is there any possibility?
Well, they do that already for investors, right? And
Okay.
so I guess the question
is,
yeah. So information rights in in a term sheet give us access to quarterly financials and their requirements around audit and those kinds of things. And so I think it's possible. I think as the number of publicly traded companies in the US continues to fall because of the regulatory expense and the amount of retail capital that wants exposure to privates increases, at some point, the government will say, well, we need increased reporting to make sure that the individual investor is protected. And as that happens, maybe you have a renaissance of small market cap exchanges to go public and investment banks start to cover those names again. But
it sounds like a good outcome, no?
I think so, but hey, the opposite has been happening.
Yeah. Okay, sorry. Yeah, I just noticed the time. One last question, I guess, before you go, if that's okay. What are you most excited about for 2025?
I feel like we're living in the future, and it makes me so happy. I mean, all of these things that we just kind of talked about or read about in science fiction, whether it's like her or self-driving cars or going to the moon, rocket systems, it's all happening. And it's just filled with optimism and enthusiasm.
Is there somebody else that you read? And I know you write a lot. I didn't really get to it, but is there somebody else that you read that you're like, wow, I wish I said that?
Most people, a lot of people. There's so many brilliant people in technology. Yeah.
Random walk, obviously. No. Yeah.
Exactly.
Yeah. Okay. I appreciate it. We're up against time. This was great. Thank you.
Thanks, Moses.
And yeah, it was awesome. All right.
Happy holidays.